the other big variable playing into all this is signs of recessionary conditions. So basically, jobless claims kind of ticking up, certain cyclical aspects, purchasing managers index, weak data out of China. So both domestically and globally, we have a lot of decelerating economic indicators. And of course, that's not usually very good for asset prices either. So the combination of a far less clear liquidity profile over the next 6 months than the past 6 months, combined with recession risk later this year or second half of this year. I think whether it's growth stocks, whether it's cyclical value stocks, it's definitely an environment you want to know what you own and be ready for pretty big variances for how things could turn out.
On today's episode of the What the Finance podcast, I have the pleasure of welcoming on Lyn Alden. He's the founder of Lyn Alden Investment Strategy. So, Lyn, thank you so much for joining the podcast today.
Thanks for having me. Happy to be here.
No problem, and I'm really looking forward to talking. You're sort of one of the at the forefront, I guess, of macro strategy, and someone that I really love listening to. So, my first question is something that I've been asking a lot of people because I'm interested in hearing their opinions on sort of the key macro drivers that they're watching. So, in your opinion, what are the key macro drivers at the moment that you think are having a big impact on the markets or just on the economies in general?
So I think it depends on the time frame. I think in the near term, liquidity conditions are a key driver. So that's something to watch. We'll probably talk about that a little bit more. Basically, dynamics between the Treasury and the Fed, and whether or not cash is being sucked out of bank reserves or not. So I think that's a big variable. Beyond that, kind of longer term, more structurally, the U.S. fiscal deficits are a big variable because they're very large, both in absolute terms and as a percentage of GDP, and that is basically a background inflationary stimulatory force. And of course, it's offset by other things, Fed tightening, trying to restrain the private sector. But you have these kind of two really big forces pushing back on each other, which is different than some prior recessions that we've had. And probably another big variable has to be China. Basically, right now, China's, they're reopening their overall kind of, coming out of their lockdowns has been kind of mild. They've had slow economic growth, and this affects things ranging from commodities to just overall global business conditions because they rival the U.S. in terms of economic size.
Yeah, it's definitely been a lot softer than I think we expected, and you could say that's maybe a global phenomenon as well. If we focus mainly first on that treasury issue, can you maybe explain the issue, why they need to raise all this money, and how that could impact, I guess, yeah, the bond markets?
Yeah, so this is something I've been tracking for a while, and for the past 6+ months, it's been a very mild scenario. It's been constructive, and the problem is that now it might turn more rocky. And so basically, the Federal Reserve is for the most part removing liquidity from the system. They're doing quantitative tightening. They had to briefly add liquidity to the system after the bank issues in March. So they've kind of been liquidity flat, but in general, they're still doing quantitative tightening. So they're still a net liquidity subtractor. Um, and in the first half of 2022, you also had the Treasury refilling their cash account. So the Treasury has a big cash account with the Fed. And when they fill that up, they're basically pulling liquidity out of the system. And when they draw it down, they're pushing liquidity back into the system. Basically, they want to maintain about $500 billion in their what is essentially a checking account. And part of the reason why the first half of 2022 was so bad for asset prices is because the Fed was no longer doing QE and the Treasury was aggressively filling up its account, and therefore you had a really bad environment for liquidity. In the second, around autumn, you started to see the Treasury cash account draw down because they were overfilled. So they were pushing cash back into the market. And so even though the Fed was doing quantitative tightening, it was being offset by the Treasury. So you went from, really bad liquidity conditions to flat liquidity, which is also when the stock market bottomed and when the dollar index peaked, all in that kind of like late September period last year. And then they ran into the debt ceiling. So instead of just drawing down to their normal cash target, they had to draw down to roughly zero over several months. And so from that period, kind of the last quarter of last year, all the way up until this debt ceiling resolution in early June, you had the Treasury offsetting the Fed. They're pushing all their cash, literally all of it, into the market, and so you had flat liquidity conditions, which was constructive, at least not terrible for a number of risk assets. Obviously, tech and things like Bitcoin, they did the best. Other areas were kind of more flat in general, but you didn't have that really negative asset period like you had in the first half of 2022. And the problem is that going forward, now that the debt ceiling has been resolved, the Treasury is once again going to refill its cash balance. So the Fed's doing quantitative tightening, and the Treasury is going to refill its cash balance. So this is potentially resuming a negative liquidity trend. It's not materialized yet, but it's something that is now on the horizon for later this month and then the months that follow. And the challenging part is to see how that's going to affect markets. So we can't be sure how it's going to affect markets, but what we can kind of be sure of is that it's a more uncertain liquidity scenario going forward than it has been over the past, say, 6 to 9 months. And I think the biggest question is, can they get that liquidity to come out of the reverse repos, or is that going to come out of banks? Because if it comes out of banks, that's when we probably have a problem.
Okay, makes sense. I know if we look at liquidity, you've mentioned it's been quite a good, I guess, indicator into the performance of the markets. And I think that's, if I'm not mistaken, in early 2022 or first half of 2022, there was, if you look at M2 money supply, if you look at sort of the Fed balance sheet, they were all decreasing. And that's where we saw those negative performance. So is that sort of the correlation that you see between, I guess, liquidity in the markets, or how does that
So
work?
that's a big correlation to any kind of given 3, 6, 9 month period, right? So liquidity really drives a lot of asset prices, at least for major asset classes. Some stocks and will still do great or do poorly based on their fundamentals. But in general, whether risk assets are doing well or poorly, in large part depends on liquidity. Um, and basically we're kind of going to get a test in the system for how tight can the Fed be when we're getting basically a record deluge of new Treasury issuance, right? So when the Treasury was drawing down, it was easy for the Fed to be tight because they were being offset. But now if they're both being tight, you could get something to break, or they could try to figure out how to get out of reverse repos, but that's harder to do.
And where do you think this will show up first? Will it be in bond markets? Will it be in the, I guess, those sales, or where are you watching?
Yes, I think you want to have to look at a couple of things. One is just general S&P, indices. They tend to track liquidity pretty closely, not necessarily on a week-to-week basis, but like on a month-to-month, quarter-to-quarter basis. That's a big factor. It's not the only factor, but it's a big one. Another one you want to look at probably is bond market liquidity, so treasury market liquidity. During the when the stock market bottomed, and the dollar index peaked last year, if you looked at what was happening in the treasury market, it was kind of ugly. So not just the yields and the performance of things like TLT, but it was also the liquidity and the volatility. So the move index was extremely high. Liquidity was very poor, right? So there were, auctions were weak. There were tailing auctions, and so you know, as the Treasury started, drawing down its cash balance, that largely fixed itself. And then the question is, now that we go into another period of Treasury's offsetting liquidity, Fed's offsetting liquidity, you probably want to pay attention to the health of the Treasury market, in addition to just asset prices in general.
And what is your base case in this? I know you said it's hard to know. Is your base case that this does occur and that maybe the Fed have to pivot or maybe they'll bring out like the scalpel and sort of find another solution that's maybe not interest rate reductions? What's your thoughts on that?
So yeah, my honest thought is it's very uncertain because and that was not my thought 6 months ago. So 6 months ago, I was like, there's actually a lot of clarity here. Until the debt ceiling is resolved, the Treasury is going to offset the Fed. And so, you always get curveballs, like, for example, some of the bank collapses, but the general asset prices and liquidity profile were pretty straightforward to map out until you got to certain points. So now I'm basically reporting that that's not the case, that I have very little certainty about the next 3, 6 months because it kind of comes down to human decisions. What is Jerome Powell going to do? What is Secretary Yellen going to do? Are they going to fulfill the TGA as fast as they say they are? Kind of like how the Fed's forward interest rate forecasts are not necessarily what they end up doing. The Treasury's own forecasts for what they're going to do with their cash balance are not always accurate. And so there's actually no way to fully predict what these small number of humans are going to do. Then there's the big question of whether or not it's going to come out of reverse repos or not. And I think that's going to be challenging to do. I think some of it will come out of reverse repos. The other big area that liquidity still is available is in large banks. So small banks are really tight on liquidity now, but say the big four or the big seven banks, they still have liquidity that this can come out of without really affecting markets too much. So we're kind of at this unusually uncertain period. And so my general advice is just basically be prepared for a wide range of outcomes, which for different investors means different things. For some means it means degrossing, not being leveraged, not taking high conviction directional bets at this time. Make sure you have a watch list. If we do get, disorderly markets, there might be things you want to buy. Be careful about over exuberance on certain stocks. So it's not that I'm like a doomy outlook, but I do have a cautious outlook until there's more clarity about what's going to happen with liquidity or until there's some sort of breakage and reversal.
Yeah, and it does seem like if you look at the performance of, I guess, the past few months, especially S&P and Nasdaq, it's been those really the five largest companies that have been driving it. Where that's where people are putting most of their money. So I guess is that where, if that were the case, that's probably where we'd see the most drawdown as well.
Yeah, there's a concern for that because if you have, especially if you have long duration treasury yields go up, that can put pressure on the valuations of some of those growth stocks, even if the growth stock fundamentals are not really impaired too much. It's more of a valuation question. The other thing we have to watch out for, the other big variable playing into all this, is signs of recessionary conditions. So basically, jobless claims kind of ticking up. Um, Certain cyclical aspects, purchasing managers index, weak data out of China. So both domestically and globally, we have a lot of decelerating economic indicators. And of course, that's not usually very good for asset prices either. So the combination of a far less clear liquidity profile over the next 6 months than the past 6 months, combined with recession risk later this year or second half of this year, um, I think whether it's growth stocks, whether it's cyclical value stocks, it's definitely an environment you want to know what you own and be ready for pretty big variances for how things could turn out.
Yeah, makes sense. And you mentioned before, and before we move on to, I guess, inflation, which is another big topic, which you've mentioned. You mentioned before that there could be money coming out from the reverse repo sort of area, which is with the Fed, or it could be from banks. If it were to come out from banks, I guess even if it was not the big banks, if it was the smaller banks, could you see maybe a repeat of the issues that we saw a few months ago with bank crises, or do you think that's maybe in the past and we might not see that?
Yeah, so if they continue on the trajectory that they're on, and if they don't manage to suck out of reverse repos, then I do think we have more risks of repeats. We still see the bank term funding program, so that's the Fed's that was their March lifeline to banks. The usage of that is ticking up. Yeah, and so there was an initial burst of usage, but then it kind of flatlined for a little while, and in recent weeks it's ticking up again. And so that's not a very positive sign. Um, so I do think that there still are risks. And again, these are human decisions. So if the Fed were to capitulate on inflation and say, hey, we're going to cut interest rates to 3% and we're not going to do QT anymore, then a lot of banks are probably fine. On the other hand, if they say, well, we're going to 6% and we're going to keep doing QT, that environment does continue to pressure banks, in my opinion. Um, Many of them have already reflected that in their price. So a lot of banks are very cheap. So I'm not necessarily saying short banks or anything like that. But I would be cautious around, especially small and medium banks, because if liquidity keeps coming out of that portion of the banking system, I don't think the banks are out of the woods yet.
And I know there's a lot of talk about, I guess, commercial real estate and other real estates as well. Do you see that as another potential risk that, especially, I guess, in some of the hotter areas over the past few years, they've seen a bit of a decrease. I think I know San Francisco, for example, where they might have to write down those sort of bonds a bit further, and that could have a bigger impact as well.
Yeah, that's well telegraphed at this point. So basically, higher rates pressure the valuations of everything. Either the two areas that are pressured the most are either unprofitable, highly valued growth stocks. So that's number one. And number two is anything with a lot of leverage. And so real estate obviously falls into the second category, especially commercial real estate. Um, and so when you look at who has exposure to that, so one is kind of the shadow banks that have direct exposure. They've already been harmed by it. The banks, a lot of them have reasonable loan to value ratios on those properties. And in addition, it's only a part of commercial real estate that's really in trouble. It's not all of it. Um, it's certain areas like offices and things like that, and just places that were over exuberant for a period of time. And so, to the extent that it rolls over and hurts the banking system is somewhat less clear. One point worth making is that on average, smaller banks have more commercial real estate exposure, lending exposure, than large banks. So large banks, not just the big four, but just generally at the top 10. If you look at how much of their assets consist of commercial real estate loans, it's generally quite low, like single digit percentage. And then even in that, let's say it's 5% for a given bank, there might only be 20% of that that's at risk. And then they have pretty reasonable loan to value ratios on that segment, right? So, is this a gigantic catastrophe for large banks? I would say no. I do think that there are some banks that are overexposed to the space. And so, people that own individual bank stocks should really make sure they understand what their banks have exposure to.
Yeah, it's a great point. So if we go on to your point about, I guess, potentially structural inflation into the near future, I know it's something that you've talked about quite a lot. And I was speaking to someone recently who said they think it's got similarities to the 1970s. And I guess there are a lot of similarities. But I know you've mentioned that you probably see more similarities to the 1940s. So I'm not sure if you can maybe explain that. And I think I got that correct. But yeah, maybe you can explain that and say why you think there's those similarities and what that means for, I guess, the coming years potentially.
Right. So price inflation is heavily correlated with money supply growth. Um, and there's two major sources of money supply growth. One is a higher than normal rate of bank lending. And the other one is a higher than normal amount of fiscal deficits, especially if those are monetized by the central bank or the banking system. And so in the 1970s, most of the inflation came from bank lending. That was actually the bigger component. You had pretty low debt to GDP ratios, you had moderate deficits, and then you had the peak record of bank lending. And that was mainly due to demographics. So the baby boomers that were born in the 40s and 50s entered their home buying years, 25 years later. And so there was kind of peak household formation, peak mortgage usage, things like that. So you had basically a credit boom at the same time as you ran into, say, oil constraints because U.S. oil production peaked in 1970, so it became more reliant on imports. So we had basically record, rate of change for demand, uh, record money, high money supply growth, and then we ran into physical constraints. So we have a very inflationary environment. The 40s were different in the sense that you had similar levels of total inflation and money supply growth in the 40s, but it was not because banks were lending. It was because the government was running extraordinarily high deficits for the war. But of course, most of those deficits get recycled back domestically. They're hiring soldiers, they're building factories, they're securing commodities. When the war is over, they put 8 million GIs into technical schools and colleges and give them mortgage support and repurpose those factories. So you it's kind of like this, almost like this massive industrial policy that happened, which rapidly grew the money supply, grew inflation, and so that was a fiscal driven type of inflation, not bank lending. And so far in the 2020s, we see normal levels of bank lending. This period of money supply growth and inflation was not because banks were doing excessive lending. It was instead because we had very large monetized fiscal stimulus. So stimulus checks, child care tax credits, PPP loans that turn into grants, corporate bailouts, basically several trillions of dollars, in addition to the baseline deficit that were shoved into the economy and became spendable money. Um, Now, going forward, we don't have the same level that we had during COVID, but because of demographics, now those baby boomers are aged, and our entitlement structures are not really accounting for that. We have far fewer workers contributing for every worker getting out now, and so we have these very, very wide structural fiscal deficits that just year after year after year are a high single digit percentage of GDP. And now we have higher interest rates on the debt. So from let's say the 1980s until relatively present, you had higher and higher public debt to GDP, but it was offset by lower and lower interest rates. So interest expense did not grow nearly as quickly as people thought it would. And the problem now is that if you still have increasing debts and deficits. But then now you have interest rates going sideways to up. Now that interest expense starts to become an increasingly meaningful part of the budget. It's already bigger than the military budget. And at these rates, it'll keep, as more and more bonds mature and get refinanced at these higher rates, it'll approach, 1.5 trillion, 2 trillion, assuming rates stay where they are. And so that is now a ongoing kind of inflationary force that's it's fiscal driven. So it's got different causes and different fixes than bank lending driven inflation that they had in the 70s.
And then where do you see this going? Do you see this going to, I guess you could say maybe just a little bit later after the 40s that there was sort of financial repression. There was this focus on, I guess deglobalization and other trends as well, which maybe prevented expansion and sort of reduced inflation? Or do you see it maybe becoming more Japanification of, I guess, the Western world? How do you see that happening?
So it'll partially depend on policy choices. Japan was in a unique situation because Japan had the largest net international investment position in the world. So even though they're heavily indebted, they owned so much foreign assets it's a very different scenario than the U.S. We have the worst like the negative net international investment position. Japan had accumulated trade surpluses into foreign assets. We've accumulated trade deficits into foreigners owning our assets. So that variable is different. In addition, um, Japan aged first, and so they still had access to globalization during that entire kind of 30-year stagnation. So even though their population peaked and their working population peaked, they had the big disinflationary, China next door, right? So tons of new labor, tons of disinflationary pressure, globalization, offsetting a lot of their money printing. In addition, they had a huge deleveraging in their private sector. So their broad money supply actually grew at the slowest pace in the world for like those 30 years. Because even though you had money supply growth from fiscal deficits, that was offset by corporates and households deleveraging, basically, declining their total loan growth, both absolute terms and relative to GDP. And so you had this kind of like flattish money supply scenario. You had this flattish economy. You had this low inflation. The United States is different in the sense that our demographics are not as bad. The whole world is now kind of aging together, and so we don't, the last 30 years with this big disinflationary tailwind of globalization, which is probably not ahead of us. And if anything, is the opposite. That we still have other disinflationary things like, tech, AI, things like that. But in terms of energy, in terms of, globalization, those are no longer tailwinds, they're probably headwinds. Um, and so I think on average, when we look out the next 5, 10, 15 years, I think it's going to be more inflationary than the past 5, 10, 15 years, pre-COVID. Um, and it'll come in waves. I mean, if they are aggressive enough to cause a recession, they can certainly give us a period of disinflation. That's kind of the period we're in now. But whenever they essentially try to have economic reacceleration, those inflationary variables are still there. You still have ongoing large fiscal deficits, and you still have pretty tight energy supplies, copper supplies, labor market, things like that. So I think the risk remains for future waves of inflation going forward.
Yeah, and what is the end game for that? Because I guess we've a lot of countries have tried, reducing deficits and trying to resolve the economy. So like Greece and Italy didn't really work. So yeah, how do you see this ending? Does it just get to the point, I guess, maybe linking back to the 1970s where inflation gets so out of control that someone like Volcker has to come in, kill the economy, but they get it under control? How do you see that happening?
So the problem is that because it's not the 70s in the sense that so they had 30% public debt to GDP, and their banks were causing a lot of the money creation. So here, the fiscal deficit is causing most of the inflation, and if you raise rates, you widen the deficit. So that's not good. That's like an emerging market problem. That's why you get emerging markets that manage to have inflation during recessions because you just have deficits just pouring more and more money into the economy that's being monetized. We're obviously not that extreme, but we're directionally kind of along that path. And that's why the tool set for fiscal driven inflation is different than lending driven inflation. So it's not really a Volcker solution. Instead, so after the 40s, how do they fix inflation? Mainly the war ended and their large fiscal deficits ended. They shifted to a period of austerity. and they grew their way out of it. And they also did financial repression. So if you were holding cash or bonds in the 40s, you got like 0 or 2% rates, and inflation averaged 6%, and the inflation of truly scarce assets was more like 8 to 10%. And you just basically got your debt restructured. Like you weren't nominally defaulted on, but you were defaulted on in terms of purchasing power. That's how countries, with their bonds and their own currency tend to default. It's usually through inflation. Um, so I think you could see a period where, on average, the next 10, 15 years, bond yields and cash yields do not keep pace with inflation. So anyone who spends a lot of time holding those just slowly, sometimes quickly loses purchasing power. Um, and as far as the actual end game, the challenge here is that so in the 40s, they at least had better demographics. They had way more workers per retiree, and so they could actually shift towards that period of austerity. Here, the probability of successfully shifting towards austerity is nearly zero, right? Because they're not going to cut the military when things are happening in geopolitics as they are. They're not going to cut Social Security or Medicare to any reasonable degree because those are very popular programs. And then because we're so financialized, even if you do cut those, you'll probably cut GDP as well. And so you actually risk the deficit still being there, even if you try to actually cut down on spending or raise taxes. It would take a pretty significant restructuring of taxation and spending in order to get that right. And that's a really high bar to cross over. And so the further we look out, the less clear it is how this ends. I would want to own other assets that are more scarce. I think we're entering a more multipolar world rather than a unipolar world. But a lot of countries have these similar problems. So I'd want to own other types of monies. I'd want to own scarce assets and really stick to the extent that I own cash equivalents, it's as a volatility reducer and a rebalancer rather than something that I expect to really hold its purchasing power over any 5, 10 year period.
Yeah, it makes sense. So let's say we're in another world, and Lyn, you are made the chair of the Fed, and then maybe also the head of the Treasury. Is there anything that they could do to stop that, or is it just it's not possible? And maybe
Well,
president, maybe you have to be that as well.
well, the challenge is so from the position of being Fed, I've often asked what would I do if I was the Fed, and I would say I'd retire. Like I wouldn't want that job because it's basically the inflation's coming from fiscal spending, which your tools don't really address. The best that the Fed can do if they want to get inflation down is basically what they're doing now, which is try to crush the private sector. So you're kind of offsetting what's happening from the public sector, but you're not actually addressing the core problem. Like, but, the private sector didn't cause the inflation, so quelling them, even though it can work in the temporary term, it's not actually solving the problem. But the Fed can't solve the problem because so it's really about Congress and the president finding a way to reorganize tax and spending in a way that doesn't also shrink the economy, which is you know going through like it's a very narrow path to get that right. And so I certainly would rather navigate this from the private sector, which is basically figuring out what I want to own, what I want to build, um, and not be the one trying to fix it because it's a very hard job.
Yeah, makes sense. So, you've mentioned a few things, but what do you want to own? And I guess what do you want to build to maybe protect yourself from this? And I know you have your own framework, which I find really interesting.
Yes, I mean I've been using what I call a three-pillar portfolio. So one pillar is cash equivalents, that's just volatility reducing. Another pillar is just long-term high quality equities. So certain tech stocks, certain energy pipelines, certain healthcare stocks, certain consumer staples, basically things I can hold and let compound for long periods of time. And then the third pillar would be more hard asset exposure, so commodities, commodity producers, gold, Bitcoin, basically either hard monies or industrial types of commodities or their producers. That's more of an inflation hedge. So with that kind of portfolio, you have a disinflation protection, which is the cash. You have kind of a growth benefit, which is the equities, and then you have inflation protection, which is the commodity side. Um, and then I'm somewhat active in the Bitcoin space where I fund, I help fund startups. I work with some startups. And I just continue analyzing that because I think that that's kind of when we think globally, there's 160 different fiat currencies. So we're often thinking in terms of the dollar. But if you're in Argentina or Lebanon or Turkey or any of these other 160 currencies, most of them are prone to more inflation on average. And should you want to move, it's not guaranteed you're going to be able to take your assets with you. Um, and so having kind of self-custodial portable money is pretty powerful. And so there's obviously volatility there, but I find that one of the interesting solutions among many in this kind of tumultuous environment.
Yeah, it's great to hear. So if we talk about, you mentioned you're sort of looking at those really high quality companies to invest in sort of the 33% of your or a third of your portfolio. I know you sort of say that you look at like it from macro perspective as well as a fundamental perspective. For you to invest in them, what is sort of the weighting on those two, I guess, factors? And then do you also take into account geopolitics? Is that sort of more weighting as well in your investment strategy?
Yeah, it's a good question. And first of all, I would point out that the three pillars are not necessarily equal. It's not necessarily that they're third each. That would, I mean, a 20-year-old investor and an 80-year-old investor have very different portfolio needs. Even if I would want all three pillars in either of them, they wouldn't necessarily be the same proportion. So there's that. As far as weighting, I tend to weight the long-term fundamentals more. To the extent that I monitor things like liquidity and intermediate term um, things. I'm generally looking at it from a setting expectation standpoint, especially because people read my stuff, listen to my interviews, and it's that I want to make sure that they're ready for certain scenarios, right? So I take small moves based on these intermediate terms outcomes. Like if I'm cautious, I might have more cash than usual. If I'm if we just had a big capitulation, I might be more aggressive than usual. But that's kind of around the margins. I kind of lean into somewhat of contrarian take on whatever's going on. But in general, I buy things with the expectation to hold them for 5+ years and then kind of change that thesis as we go. And that's, long-term fundamentals of the company. What's happening with macro? Like, do I expect structural inflation or disinflation? And then geopolitics. I mean, there are some jurisdictions that are more dangerous than others. Are there some that are cheaper and better positioned than others? And so I kind of I do take that into account as well.
Yeah, I guess bringing in more points. I'm sure there's always lots of things to think about in terms of risk management and I guess as well portfolio construction. Is that other things that you're sort of looking into getting that diversified portfolio, or do you think sort of the pillars help to maybe balance that out?
I think the pillars help to balance that out. I mean, that's the framework. I mean, obviously within equities, you can have very different sectors to make sure you're not exposed too much to one sector. So you can diversify within the pillars. You can also combine that obviously with home ownership, real estate. That's kind of a whole separate pillar. You can kind of consider it. Um, and then there's obviously just your physical life, right? So where you choose to be located, uh, you know, what kind of networks are you building, that kind of thing. So those are obviously other ways to make decisions that can have a very significant impact on what your life is like over a 5, 10, 15-year period.
Yeah, great point. So, Lynn, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
I think a key thing is to measure and be cognizant of your own level of conviction, right? So some people are sure all the time, some people are never sure. And you don't want to be in the position where you're sure all the time, right? So a lot of people they just want someone to always be like super confident, here's what's going to happen. But that's not realistic. There are some times where you are things are very clear to you. You're on your game and the macro outlook is like clear and you can make higher conviction directional bets on things. There are other times where you have to be aware that either because you're not on your game at the moment or because the market is just literally more uncertain in that moment. Is that like a pivot point that you are less it's less clear, right? And so I think being able to identify the difference is a key thing. And if you watch Stanley Druckenmiller interviews, that's something that he is very strong in. He's basically the best macro trader over over like a 3-decade period. He did incredible, and in large part, it was because he identified when either he or the market was clear, and he could really push it, or when either he was off or the market was weirder than normal, when he'd say, okay, I'm going to degross until I have one of those clear moments.
Yeah, so just taking advantage of when you can sort of understand what's happening. And I guess,
Yeah,
he's done that before and then he bets big and
yeah.
asymmetric risks and he's done pretty well off it. But yeah, thank you so much for your time. I really appreciate it. So, if anyone want to find more about your work, we've mentioned sort of your investment strategy, I guess the research company that you sort of founded, as well as would Twitter be the best place? Is there anywhere else people can find what you do?
Yeah, so on Twitter, I'm at Lyn Alden Contact. I tweet a lot. And then also my website is lynalden.com. And I have a free newsletter that comes out every 6 weeks, as well as public articles that people can look at.
Perfect. I'll put that all in the description below. But thanks again for your time.
Thank you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.